Everyone has their own explanation for why Bitcoin has been struggling lately. Some blame ETF flows, others point to forced selling or large holders taking profits. And yes, all of that plays a role. But there is a much bigger factor, quietly influencing institutional behavior, and most of crypto Twitter is barely talking about it. In mid-January, one of the most widely followed institutional strategists made a major portfolio decision. Chris Wood, the longtime author of the Greed and Fear strategy letter, eliminated his entire Bitcoin position. That allocation made up roughly 10% of his portfolio. Instead, he rotated that capital into gold. The reason was not regulation, not ETFs, and not price action. It was quantum computing risk. That single decision matters because it reflects how institutional investors think about long-term survivability, not short-term narratives. And once you understand why this risk is being discussed at the highest levels, Bitcoin's recent underperformance starts to make more sense. This concern is no longer coming from fringe voices. Major asset managers have begun updating their risk disclosures. ETF filings now explicitly mention quantum computing as a potential threat to cryptographic security. Large crypto firms are publishing institutional research on the topic. Custodians and prime brokers are warning clients that this is no longer a purely theoretical issue. These are the same institutions that spent years pushing for Bitcoin ETF approval. They are not anti-crypto. They are risk managers. Retail investors often ignore this discussion because it feels abstract and technical. Quantum computing sounds distant, hard to model, easy to dismiss. But markets do not wait for certainty. Institutions price in probabilities, especially when the downside is existential. To understand why this shift is happening now, you have to look at how quickly the quantum timeline has changed. For decades, quantum computing lived mostly in academic papers. The math was interesting, but the machines were unstable, error-prone, and impractical. Even after the discovery in the 1990s that quantum algorithms could theoretically break modern encryption, the assumption was that usable machines were many decades away. Bitcoin was launched in that environment. The cryptography it relies on was considered secure for the foreseeable future, and at the time, that assumption was reasonable. What changed is that quantum computing is no longer stuck in theory. Late last year, a major breakthrough demonstrated that a quantum processor could solve a benchmark problem in minutes that would take classical supercomputers longer than the age of the universe. That moment shifted the conversation from if to when. Since then, timelines have compressed dramatically. Leaders in the semiconductor industry have publicly reversed their estimates within months. Governments have escalated funding and classified quantum development as a national security priority. Global investment commitments now total tens of billions of dollars. Even more important, expert forecasts are converging. Consulting firms estimate cryptographically relevant quantum machines could emerge within a decade, possibly sooner. Defense agencies plan for scenarios measured in years, not decades. Leading cryptographers and blockchain researchers openly acknowledge that a fault-tolerant quantum computer within the next few election cycles is no longer unthinkable. When independent experts with different incentives start landing in the same time window, institutions take notice. So how exactly does this threaten Bitcoin? Bitcoin relies on elliptic curve cryptography to secure transactions. In simple terms, your private key proves ownership, and your public key allows the network to verify it. With classical computers, reversing a private key from a public key would take longer than the lifespan of the universe. Quantum computing changes that math. A sufficiently powerful quantum system could theoretically derive private keys from exposed public keys in a matter of hours or days. And here is the part many people miss. Once a Bitcoin address spends funds, its public key is permanently visible on the blockchain. That means attackers do not need to act immediately. They can collect data now and decrypt later when the hardware is ready. Research estimates suggest that roughly a quarter to a third of all existing Bitcoin supply sits in addresses that are already exposed in this way. At current prices, that represents hundreds of billions of dollars. Then there's the additional complication of early wallets, including the coins mined in Bitcoin's earliest days. Those addresses use older formats that cannot be upgraded. If quantum capabilities arrive before mitigation, those coins become accessible to whoever gets there first. This is not about whether Bitcoin fails tomorrow. It's about how long-term capital evaluates risk. Institutions do not wait for disasters. They discount assets when tail risks remain unresolved. The possibility alone affects valuation. This is also why comparisons to gold matter. Gold does not rely on encryption. It has no software dependencies, no upgrade cycles, and no attack surface. For allocators with multi-decade horizons, that difference is not philosophical, it's practical. Bitcoin markets itself as digital gold, but digital assets come with digital risks, and until those risks are addressed, they stay priced in. From here, there are only a few realistic paths. One scenario is inaction. Quantum technology advances faster than Bitcoin governance can respond. Exposed keys are compromised, confidence collapses, and supply floods the market. This is the worst outcome, but it becomes more likely the longer preparation is delayed. The second scenario is reactive upgrading. Under pressure, the network scrambles to adopt cryptographically resistant cryptography. Technically possible, but historically slow, contentious, and messy. Coordination at that scale would take years. The third scenario is proactive coordination. Standards are debated early. Wallets migrate gradually. Infrastructure is prepared before urgency turns into panic. This is the only scenario that removes the survivability discount, but it requires leadership and action well before a crisis. The challenge is that Bitcoin has no central authority. Decentralization is a strength, but when facing systemic threats, it becomes a coordination problem. Past upgrades have taken years of debate. A post-quantum migration would be far more complex. So that's why this matters now. This is not a call to panic, and it's not a declaration that Bitcoin is doomed. But dismissing this risk entirely is not rational. The institutional investors stepping back are not acting emotionally. They are doing exactly what capital allocators are supposed to do when faced with unresolved tail risk. Until Bitcoin clearly addresses its quantum future, that risk premium stays in the price, and markets are already reacting.